much money are you saving at the moment? You shouldn't judge others for not managing, because saving is really tough. And it is tough enough to try and get South Africans to save for a rainy day, or even a sunny day for that matter. But how much do we know about savings vehicles? The world of investing, of course, is increasingly complicated. And even something as simple as an exchange-traded fund is becoming more and more complicated as more and more options become available. It's opening up the world of the universe of investing, and it's really good. But suddenly, where you didn't need advisors in the past, you suddenly need advice like you do on the sale of unit trusts, and that's got to affect the cost of low-cost ETFs ultimately as well. This is the MoneyMakers. I'm Bruce Whitfield. I'm joined by Lance Solms, who's the head of Itransact, to look at why ETFs may very well be the vehicle of the future for so many investors. They haven't taken off in South Africa to the extent that they are part of the fabric of the investing psyche in the United States, Lance.
Absolutely. I think the American investor, they've been brought up on stocks and in their whole dynamic, where South Africans have very much been brought up on financial advisors and the traditional way of investing through traditional unit trusts, and always seeing the fund manager standing up on the stage delivering his returns, and not necessarily the asset management company. I think that's the fundamental difference why they're not so popular. Although they are popular in the financial advisor industry, financial advisors use them to great effect to lower costs for investors like you and I. But there is just south of 100 million in exchange traded funds at the moment, so it has grown significantly. It
is growing, but I mean, I think it's a John Bogle. He's like the godfather,
that's right,
of ETFs in the United States. And his arguments make ETFs a no-brainer of an investment decision, particularly in the United States, where they've had a really nice bull market. And we've got the Dow in record territory, we've got the S&P 500 in record territory. Markets have never looked this good. That's a very happy environment in which to be selling ETFs. However, if you look at South Africa, over 3 years, our market is flat. And if you bought the Satrix 40 3 years ago, you haven't made very much money. And it makes the sale of ETFs here a bit harder, I would guess.
Well, there's more than just the top 40, and I think the most well-known ETFs are top 40. But had you invested in a multi-asset ETF, you'd be looking a little bit different than had you invested in a top 40 ETF. In other words,
the vast majority of people, however, without financial advice, struggle to come to terms with the concept of the Satrix 40. Never mind talking about multi-asset ETFs. Suddenly, you're going into the sphere where people now want to go and engage a financial advisor to get the guidance to do that.
Well, Bruce, that's exactly why we have taken ETFs or exchange-traded funds out to financial advisors, because it really belongs in that environment where it can be exposed to investors who've only been exposed to what now is termed as active investing. And passive investing is still a very new concept to South Africans. And yes, it is going to take quite a long time to gain traction, but interviews like this or press recognition of ETFs plays a huge role, because when the media looks at the top 100 unit trusts, they don't really look at the top 100 unit trusts, because there are these other guys called ETFs, and they should be put in between there. And for example, if you had invested in a normal top 40 ETF, you would have beaten 95% of all active managers out there who invest in equities.
Over what time frame, though? Because this is where it becomes a delicious fight between the active managers and the passive guys. Because suddenly it says, okay, when do you start and when do you finish? So I pick a start point of 3 years ago, and I'll find a lot more than 5% of active managers outperforming a flat JSE over that period.
Correct. Everybody shows their returns over these long linear periods, which is not the user experience at all. The actual investor experience, he comes in and he goes out at different timescales. But over any given rolling 3-year period, the average, and this is statistical average from guys like Morningstar, Profile Media and so forth, they're the number they'll say is that 75% of all active managers who invest in equities underperformed their index. And the simple reason for it is that for an active manager to perform, he has to already be at what the cost of the ETF is. Now remember, we're dealing with ETFs that are right down at 15 basis points, which is the 15th of a percent for a top 40, for example, where you got the average manager in South Africa is charging the customer 1.8. And as you and I both know, if your fund returns 10% and your fees are a measly 1%, if a measly 1% translates into 1% of 10% is I mean, is 10% in returns.
You compound that over the life of an investment. You compound that over a 10-year investment or a 20-year investment, and costs then become a very significant factor in the world of performance, because you're paying your advisor a percentage point, you're paying the fund manager 1.8%, plus there are lots of hidden fees and charges and stuff. You end up paying up to 300 basis points away in fees in the active space. Correct. You lose a lot of performance over 20 years.
You do. In actual fact, you lose almost half. At 3%, in actual fact, you lose almost half. At 4%, you almost lose 3/4. And we've done the exercises on 5%, and you've got nothing. And that is why most South Africans don't retire.
However, if you choose the right fund managers over periods of 5, 10, 15, and 20 years, you then get what the fund managers like to call alpha, which is outperformance. And you're in the pound seats. They can charge what they like if I outperform the index.
If you outperform the index, and if you're good at picking the right guys at the right time. And I think, again, it's very difficult to predict the market. I think it's human nature. We all believe we can outperform the market, but it is in actual fact, over any given time period, exceptionally difficult to outperform the market. And there's one simple reason for it. To continue to outperform the market, you need to keep taking on risk.
Yeah.
And eventually that risk will work against you. Or your fund mandate will say you can't take that risk, and therefore you can't participate in this nice run, or whatever the case may be.
I mean, one of the reasons why ETFs have done so well in recent years is because so much of the index has been made up of the big gorillas of the Naspers, the SAB Millers, for example, making up something like 25% of the top 40 index in terms of the performance. Suddenly, SAB Miller disappears out of the index forever. It is gone. It no longer exists. It's in this thing called AB, InBev, SAB, Mega Brew, whatever they decide to call this huge brewing giant. That performance is going to be nowhere near the performance that we've enjoyed out of SAB in the last 12 to 18 months, courtesy of the buyout offer.
Correct.
Suddenly, buying the Satrix 40, and I stress this one again, looks very unattractive over the next 12 to 18 months, because that huge part of the index is gone.
Absolutely. And I think, when the Satrix 40 was launched, was almost, I think, 2001. There are a lot of other products that have come in the market. I mean, you get a top 50 now, because obviously there's a lot more liquid companies in South Africa since 2001. But I think ETFs have evolved to beyond just carrying core shares in it. And there are a lot of ETFs out there that will work, that will deliver results when things like this happen. There are various brands of ETFs, various strategies out there, and it all is confusing.
Are they still ETFs? Because now suddenly you're actively managing an ETF. It's an actively managed fund, isn't it?
Well, there's nothing passive about an ETF, I guess. There's a lot of mathematics involved, and that's where the activity is. What they mean by passive is once the mathematical algorithm has been set and cast in stone, then it is passive. Then it's just a rules-based product. You get this concept called smart beta, which you've probably heard about.
Just explain what it is.
Smart beta is sort of the marrying of active and passive. But at the end of the day, that marrying of active and passive means you're trying to make something that tracks a market outperform the market, which doesn't make sense again, because that means there's costs involved. And the prime reason for buying an exchange-traded fund or a blend of exchange-traded funds is to get the performance of the market, which means over time you will beat most managers, and to get the cost reduction, because we all know that over time, just as your interest compounds over time, your costs compound over time as well. And so the two should be kept apart. They work very well in conjunction with one another, although I wouldn't say that they work well in the same product. You would need an active strategy and a passive strategy, and they almost hedge each other out.
We've just locked 99.9% of South Africa out of investing. How do we get, because the idea of the ETF was just so nice and simple. You could put 300 Rand into Satrix 40, you could forget about it, and you would get the performance of the market. That was an easy sell. Not many people bought it, but that was the easy sell. The ETF market has become far more opaque.
In certain sectors, yes, it definitely has, but in some sectors it's become very, very visible. And one of them are the pension fund industry. The pension fund industry has got a huge amount of benefit by including passive inside their funds.
But that's also, and that's fine, because it's an industry understanding the process, and they're reducing their costs, they're reducing costs to their members, and that's the way it should work. In the retail space, I mean, 99% of people don't know what their pension fund invests in. I mean,
no, they don't.
They take a dart, they throw it at the board. They throw and hope to hit a bullseye, and trust that the fund manager is going to do the bullseye hitting for them, don't they?
Correct. But I think in South Africa you'll see what's happening overseas a lot. And Warren Buffett has said it many times. If you want a good pension fund, go buy 90% S&P 500 and they can put the rest in cash. So I think more and more the end user like you and I are indirectly getting ETFs or exchange traded funds in the mix by virtue of the pension fund actually buying tracker funds or tracking certain parts of the market, which makes absolute sense. Buy the meat and potatoes of your fund cheaply and as efficiently as possible, and then get the smart guys that you're paying big fees for to go and chase that alpha, that very elusive alpha. And that seems to be the best way to do it. But there are a lot of new platforms that are coming on the market, and I think you're starting to see a lot of new breed platforms. Ours is one of them. That are arriving on the scene, offering a very different product set directly to investors, or via through financial advisors, where literally we've got products that farm workers own on farms, and they literally have a basket of stocks on the stock exchange, albeit in the form of exchange traded funds. So I think you're just starting to see the first little bits and pieces wash up on our shores. I think it's going to get a lot stronger. The active market is coming under threat, especially with costs, and you're going to see a lot of ETFs start replacing a lot of strategies that you currently see.
But you're not living in a dream world where people are going to do this for themselves. A tiny proportion of people trade shares in their personal capacities. They might trade some ETFs. They might do it themselves.
Correct.
But this, like insurance, and sorry for the correlation, like insurance, investment has to be sold. People have to be sold the advantage of investment over a period of time.
Absolutely. You're going to see more and more financial advisors adopt platforms that offer ETFs, and not just adopt platforms that only offer the top
and that changes as the payment model for advisors changes as well. If they're not getting a percentage of the portfolio, or maybe they are in big portfolios, if they're getting an upfront fee to manage a portfolio with an update every year, the incentive to sell the actively managed fund also evaporates.
Well, Bruce, therein lies the problem. A lot of platforms, a lot of companies in South Africa today will not put passive or tracker funds on their platforms because it's not good for business, because they're cheap. They're cheap and they do better. So why would you want to sell them if you're making your money out of selling things with high fees? But those guys are going to have to come into line, and I think regulation like RDR, which is the Retail Distribution Review, treating customers fairly, and this latest one that's coming out, which is certainly my favorite one, which is effective annual cost. And that means that everybody has to disclose all their fees.
You'll actually know what investments cost?
You will. You will. It's going to have to be like your nutritional content on the side of the tin of food.
Yeah, but if you make the print this small, nobody's ever going to know anyway. But we have to leave it there. Effective annual cost.
Effective annual cost. It's the best thing for the consumer that's ever happened.
Producers, we need to talk about effective annual cost. Thank you to Lance Solms, who is the head of Itransact. There'll be more ways to save money, tips to grow your money, and insights into the world of money making on the Money Makers next time. For now, though, sleep well. Bye-bye.